Welcome everyone. Hopefully you can hear me okay. I'll try not to cough too much. And welcome to one of our webinars in the series that we're going to be doing on various matters at Johnston Grocke. My name is Andrew Brown. I'm a Director of Business Services at Johnston Grocke. Today our hot little topic is the contentious issue of South Australian land tax. Just want to run through what we're going to be talking about over this short webinar. It's not very long. It's probably only 15, 20 minutes. A little bit of time at the end for some questions, if anybody's got any. Very high level, we'll be talking about what the government's proposed and what this means under their aggregation model. A couple of little case studies, strategies, and where to from here. Now, just to preempt a little bit, naturally we deal a lot of time with Australian-based legislation covering the whole of Commonwealth of Australia. It's not that often we get anything significant on a state basis. So as you may or may not know, land tax is one of those things that is governed by states, as well as stamp duty, for example. So given that it's focused purely on South Australia, it's a very niche, unusual change to our little economic environment here in South Australia. And it's going to have some big impacts for people. Potentially, yet to be ratified by the government, but it's working towards that. And as we move forward, we'll find out a bit more. But this is to give you a heads up on the large global look of it. Naturally, we wouldn't be accountants if we weren't going to make a disclaimer, so please read that, general information only. But of course, we can talk later on individual situations. So what's government proposed? So essentially from 1 July next year, there'll be a change in the way that land tax is assessed. And they're trying to, I guess, make it a fair playing ground for people over time. And what they're trying to do is aggregate multiple holdings to a key person or to a key person that owns those holdings. Now, in the past, traditionally, holdings have been broken up into companies or trusts and separated, so land tax wasn't aggregated. And this is a theory that the state government's trying to overcome. This is essentially a little bit of the plan for them. Whether you can take it with a grain of salt, we'll see how it goes. I mean, 10 years looks like a long lead-in time for some of these changes, but that's their proposal. So let's have a look a little bit further and go on the current model. Now, essentially, land tax is charged on most properties except for primary production land and some charities and personal homes. And that's usually caught in the declaration when things are rented out, but obviously sometimes too, state government does searches, for example, on residencies, tenancies tribunal, and they may find out, determine that your property's been rented out and charge land tax on that. So they're searching for properties that are in this category where they have to charge land tax. And it comes into effect if it's worth more than about $390,000. And of course goes up. If the property's worth more, land tax goes up. So it's not overly complex. And this is sort of how it's being dealt with at the moment, where it's being dealt with on an individual entity basis. So for example, in this one, we've got a family trust holding property for 500, another investment property held in the spouse's name for 500, one held in family company for 500. We've got a second trust, another $500,000 property here, obviously buying things at the right time. Now, they're individually assessed currently, and if we work on this, it's just say it's $2,000 per annum, so we're not talking a huge amount of money. That's individually assessed. So let's look at what the implications of what's happening with the government at the moment. So currently, in that previous example, we had an individual owning a property, two trusts, and a company. They were all separated. And the purpose of that, in this instance, was to reduce land tax. Now, we use these basic structures, these five that you see noted are the basic structures that we use for holding assets and businesses. And one of the reasons we use them is to manage tax impacts. So not only income tax, but land tax. We also use them for things like asset protection. We use structures for succession planning. We use structures for international tax, for international dealings. So this is why structures are important, and they've been put in place not just to minimise things like land tax, but for other reasons. And this is the reasons why the government probably in the past had difficulty in assessing the ability to charge land tax, because they weren't sure on who was behind those companies, who was behind those trusts. And in a trust situation, as you may or may not understand, we have a trustee, and often in trust situations, there may be a discretionary situation with trusts whereby we don't actually know who the final beneficiary is. It's a discretion at the benefit of the trustee, therefore it hasn't been linked to an individual. Excuse me. So we've got a complex situation here where entities are used for various reasons, and state governments trying to overcome these use of entities to aggregate the properties for a key individual to charge land tax. So the proposed aggregation model is a trust company will be aggregated to an individual to work out the purpose of determining land tax. Basically, as you can guess, aggregation is bringing assets together to work out a number that they would cover. So let's look at a basic example here. We've got, again, same situation. We've got a house held in the spouse's name, company, 2 trusts. This could be rough numbers we're talking about. So it's quite a significant jump from what we used to. And one of the challenges that you've got to have as an investor, as part of your investment strategy, is the trade-off between taxes like this and the other strategies for wealth creation or asset protection, being income tax, being estate planning, risk management, succession planning, and those kind of things. So structures may still be important, otherwise we'd scrap them all and just go back to a very basic scenario. But we've still got to take into account sector tax, because that may affect the outcome or the investment strategy of your property portfolio. So what's happening here with properties held in trust? So what they're trying to do, as I said before, they don't know necessarily who the trust really is linked to. It's really hard to determine that sometimes. You may have a director of a company who's actually unrelated to the beneficiaries of the trust. So what the government says that you need to nominate by June next year, a key person to be linked to that trust. This is purely for land tax purposes, for no other reason. You link that person to the trust, then land tax will be able to aggregate that person with the assets in the trust. So for example, if I held an asset in a trust and no other land tax property, potentially I could get a cheaper result. They're actually reducing land tax individually on an individual basis. However, if you don't link the person to the trust, then the land tax is increased in the trust. So they're encouraging you to aggregate. If you don't aggregate by nominating a person, you pay a higher level of land tax in the trust. So to some degree, we need to do the numbers to see what's the right answer. Now, noting this, super funds are exempt from this. They are excluded. Generally, in a lot of situations, they're what they call excluded trusts. They'll deal with their own land tax separately. They won't be aggregated in this model. So we're only talking about discretionary trusts, essentially. I'm sure there's a lot more devil in detail going to come out in this, but there'll be some more information as it comes out over time. So it's all about aggregation. So this gives you a bit of a feel for what might happen. And it gives you an idea as properties increase, and these days it doesn't take much to hold a property, investment property, especially if it's commercial, over $1 million. You can see the rate of land tax that's happening. Now, it's important in an investment sense because generally commercial property owners are price takers. We can't determine the level of rent we're going to charge. The market will determine the rent for us. If the rent's too high, the tenant leaves. So we're price takers. To some degree, we have to wear the cost. The media is saying that the costs can be passed on to the tenant. I tend to think it's probably not correct. It'll probably be more so that the landlord will wear the cost. So this gives me an idea of the increase of land tax potentially under these kind of scenarios. The impact on the government's reduction of land tax on individuals, potentially, is a bit of a concern for me. The Valuer General is going through undertaking its revaluations, as they do. That's going to be happening over a shorter period of time, potentially. And of course, if property values go up, you might be saving on land tax in your scenario, but then we expect to pay more for emergency services levy, council rates, water rates, etc. So my concern is that this won't be a net benefit outcome for some people at all, even though the state government may say so. Devil's in the detail, as always. Got to keep an eye and watch this space. Now, this is the kind of things I've just done a short list of the things that matter. So, in part of our investment strategy, you need to consider income tax, capital gains tax, GST, stamp duty, risk management, estate planning, succession planning. So these are all things that may be more important than actually dealing with the land tax. So, for example, one of the reasons why we operate trusts is for risk management for businesses, to separate it from personal liability. We don't want to have them in our own individual names because of that personal risk. Hence, you may be factoring in a risk premium to own the property in a trust because of risk management. Same thing with estate planning. It may be more appropriate to have an estate owning assets, or an entity owning assets for purposes longer term for the family, and you're prepared to wear that potential extra land cost via land tax because you need to protect that asset in a different structure. So I think it's a holistic view that matters. I'd like to think people have a bigger, longer term strategy than just an knee-jerk reaction. There's been a lot of media out recently about this, and you see that the property council have been giving the state government a hard time. I don't disagree with some of it, but we need to look at the wider picture as well. Now, what we're trying to do here, obviously, is make sure people are informed, and it's really, really hard to cover off on everything. And it certainly can't do it in this short webinar that we're doing. But we're actually saying to people, look, let's at least have a go at doing a review. We've tried to work out a bit of a number on the time it takes for us, knowing your situation, to review the structure, work out what needs to be done, if anything, and try and cost out what it would look like. Now, again, remember this only applies to properties in South Australia. So for those people who've got property in the state, rest easy until the state government's there to do something. Have a think about your situation. It is complex. It is a bit of a moving target. We've got some timelines to meet. I suspect if we've got to lodge this beneficiary form with the state government by June 2020, if we are going to do any structural changes, in other words, move assets out between structures for whatever reason, especially if you have debt in that, I suspect would need to have it already in place by the end of March, for example, because it takes time to do conveyancing, take times for the bank to reassess things. So it might seem it's a fair way away to make a call, but I'm not quite so sure on that, especially Christmas is interrupting our procedure. So have a think about that, and people can come back to me with any thoughts on their desire and urgency to do these things. As I said, with the client base that we're dealing with, there's quite a degree of property there.